Hello everyone, welcome. My name is Chris Phelan. I'm the new chair of the Department of Economics, and I want to welcome you to the Heller-Hurwicz Economics Institute, the first Heller-Hurwicz Economics Institute event of the 2012 academic year. It's on tax reform, lessons from economic theory. We're delighted to have you all here tonight for this important discussion. For those new to our program, the Heller-Hurwicz Economics Institute is a global initiative of the Department of Economics and the College of Liberal Arts at the University of Minnesota. HHEI was created to inform and influence public policy by supporting and promoting frontier economic research and to act as a bridge between that research and the outside world by communicating our findings to leading academics, policymakers, and business executives around the world. Like our previous events, our audience tonight is in many ways as distinguished as our panelists. I especially would like to welcome and thank Jose Perez, one of our very own distinguished PhD alums and Regional Managing Director of U.S. Bank's Ascent Private Capital Management, which is our corporate sponsor for this evening's program. It goes without saying, but I'll say it anyway, how much we rely on and appreciate such support. Also here tonight is one of our university regents, John Frobenius, as well as alumni and students and friends from the Federal Reserve Bank, the business community, the media, and the legislature. I hope you will join the Institute's mailing list so that you can continue to be notified of upcoming events and news. Just go to hhei.umn.edu for more information. Without further ado, I'd like to introduce our moderator for this evening's program, Laura Kolumbakidis, a tax expert in her own right. Laura is an associate professor in the Department of Applied Economics and a University of Minnesota Extension economist. She teaches public finance and does research on a range of federal and state tax issues. Her current research concerns tax incentives for economic development, state business tax policy, and subsidies for charitable contributions. In 2009, she served on Minnesota State Budget Trends Study Commission, and in 2011, she was one of a group of economists and Minnesota Department of Revenue staff who produced the Tax Expenditure Review Report. She's been interviewed by numerous media outlets, including the Minneapolis Star-Tribune, the St. Paul Pioneer Press, and the Minnesota Public Radio. Prior to joining the University of Minnesota, Dr. Kolumbakidis worked as a financial economist in the U.S. Department of Treasury Office of Tax Analysis. Professor Kolumbakidis.
I think we should just bring our speakers up, and I'll introduce you and say a few additional words. So thank you, Chris, and I'm very pleased to be here this evening and to have the opportunity to introduce our speakers, Professor Joel Slemrod and Professor V.V. Chari. I'm first going to introduce our speakers, and then I'm going to say a few words setting the context for the current context for tax reform. And then our speakers are each going to make a presentation, and then we'll have chance for questions and answers, which I'm sure you're all looking forward to. So first, introductions. Professor V.V. Chari is the Paul Frenzel Land Grant Professor of Liberal Arts in the University of Minnesota Department of Economics and an advisor to the Federal Reserve Bank of Minneapolis. Professor Chari's research has focused on business cycle theory and business cycle accounting, financial intermediation and bank regulation, financial crises, dynamic optimal tax policy, and capital taxation, among many other topics. Chari has served on the board of editors of many journals, including Econometrica, the Journal of Economic Literature, and the Journal of Economic Perspectives. He's been named a Fellow of the Econometric Society and a Scholar of the College of Liberal Arts here at the university. Finally, Chari is the founding director of the Heller-Hurwicz Economics Institute, which brings us all here this evening. Second, Professor Joel Slemrod is the Paul W. McCracken Professor of Business Economics and Public Policy at the University of Michigan's Ross School of Business. He's also the director of the Business School's Office of Tax Policy Research. Professor Slemrod's research spans the full range of tax policy topics, including tax evasion, administration, and enforcement, taxation in the global economy, the behavioral effects of taxes, corporate taxation, and many others. Slemrad's book with John Bacchia, Taxing Ourselves, is the modern text on the eternal debate about tax reform. Joel has been both the editor of the National Tax Journal and the president of the National Tax Association, and he is this year's recipient of that association's prestigious Daniel M. Holland Medal for outstanding contributions to the study and practice of public finance. Finally, I should note that Professor Slemrad began his career on the faculty of the economics department here at the University of Minnesota, where he crossed paths with both Walter Heller and Leo Hurwicz, the namesakes of the Heller-Hurwicz Institute. So now, the current context for tax reform, so setting the scene for lessons from economic theory and prospects for the future. So the end of 2012 presents considerable uncertainty for public finance in the United States. Against the backdrop of the European Union's sovereign debt crisis and the U.S. economy's own sluggish recovery, the U.S. presidential election will determine which of two contrasting views of tax policy's role in stimulating economic growth will prevail in the White House. So will it be raising taxes on the wealthy to reduce deficits, or lowering taxes on capital to stimulate investment? Meanwhile, U.S. lawmakers, U.S. Congress, are facing a choice between extending deficit-increasing tax cuts and allowing a recession-threatening fall from a fiscal cliff. Well, it seems that there's always agreement that the U.S. tax system is in need of reform. There's often not agreement about how that should be done. However, this particular context places us in an unusual situation, well, maybe not an unusual situation, but in a specific situation that in classic tax reform, the support of taxpayers who lose their favorite preferences to base broadening is bought by revenue neutral lowering of tax rates. And I wonder that if considering the current federal fiscal imbalance, will we have the luxury of revenue neutral tax reform? Or will revenue increases be the only option? So within that context, it's hard to imagine a time that could more urgently call for constructive, theory and evidence-informed discourse about what the U.S. tax system should look like. And with that, let's begin the discourse. So I don't know which one of you is going to go first. Okay.
Thank you, Laura. Let's see. I should try and make this a full screen. Can I? Okay, great. Okay. So I'm going to talk a lot about what I think lots of economists, certainly a lot of economists whose work I like, tends to suggest about the kinds of principles that ought to guide public finance. So in thinking about these principles, it's useful to start with a quotation from a great public finance expert, Jean-Baptiste Colbert, who served as Minister of Finance under Louis XIV. So he was Minister of Finance to a true thug. And he said, the secret of public finance is to extract the most feathers from the geese with the least hissing. There's actually an element of truth to that. The secret of public finance and the theory of public finance is how do you extract the needed amount of revenue while distorting decisions as little as possible. In other words, while minimizing the hissing, except hissing here comes from the fact that all taxes distort decisions. And the key margins that I'm going to focus on, that I've focused on much of my work, is how do tax systems affect decisions about how much people work, how much they save, that is, how much they consume less today in the hopes of consumption in the future. A final principle of public finance is that budgets must necessarily be balanced, not necessarily year by year, but they have to be balanced in a present value sense. And certainly the recent history of U.S. fiscal policy seems to reflect the view that budgets don't have to be balanced forever. And that's just infeasible. All right, so the place where most economists who think about public finance issues and how to set taxes come from is that at the end of the day, there are really only three kinds of goods, all of which fall under the category of what are called primary goods, which can be taxed. And that's consumption, how much you consume today, tomorrow, in the future, every date in the future, labor income today, tomorrow, ever into the future, and whatever capital in the sense of buildings and equipment and so on, our parents and our forefathers have bequeathed to us. Once you think about all tax systems in terms of their effect on consumption, labor income, and existing capital income, you arrive fairly quickly at an answer to the question, what sorts of principles should guide tax systems? There's a presumption in a large class of economic models that we write down, not really a presumption, but an implication of a large class of models that we write down, that uniform taxes on consumption or on labor income, uniform over time, are desirable. The moment you start with that idea that uniform taxes are desirable, then it turns out, perhaps somewhat surprisingly, that income from investments made in the prospect of generating income in the future, starting today and tomorrow and in the future, should not be taxed. Income from the capital that our parents gave us, that's fine to tax that, but you don't want to tax the investments that we and our children would make. Why is that? The reason is that any system that taxes income from capital, by that I mean dividends, interest, capital gains, and so on, turns out to be equivalent to a system that effectively taxes consumption at ever-growing rates. It means that consumption tomorrow is more expensive than consumption today, and that ever-rising increase in capital income taxes, which implies that our great-grandchildren will pay taxes effectively on their consumption relative to ours at a several-fold rate to the rate that we do, leads to inefficient, undesirable outcomes. So the end story of all this is that good tax systems often have the feature in our economic models, have the feature that it's desirable to tax capital income that our parents have bequeathed to us relatively heavily, but not to tax capital income going forward, because that introduces undesirable, unnecessary distortions. So the bottom line from all this is that it's desirable to tax consumption at fairly constant rates over time, desirable to tax labor income at fairly constant rates over time, and that the idea of including capital income in that, excluding the capital that our parents gave us, is pretty strong. So what does all that mean? The moment I talk about consumption taxes, typical person in most audiences says, oh my God, does that mean that all tax systems have got to look like sales tax systems? Do they have to be effectively, in economist jargon, linear? That is, do we all have to pay 20% VAT or 20% tax? That kind of tax system is not something the person in the audience says, I like because I want to achieve certain goals of progressivity. And the answer to that question, as you'll see in a moment, is absolutely not. One can design within, for example, the framework of the US tax system with relatively straightforward modifications, a tax system that's as progressive in terms of taxing people with relatively high levels of consumption very highly as you desire. There is, from an economist's perspective, there is no sense in which the principles that you ought to tax consumption imply at all that the consumption tax cannot be progressive. And I'll describe how one can construct progressive consumption taxes. I personally would like the tax system to be much more progressive than it is today, but that's the answer that I'm going to arrive at is independent of my own preferences. Some of you might like it to be less progressive. And to some extent, it's very hard for an economist to give advice on the right level of progressivity. That depends on the right level of ethical and moral concerns that you have across people with different income or consumption levels. All right? Okay, so I view the economist's job as saying, this is the level of progressivity you want. Here is the most efficient way of achieving the outcomes that you desire. Here is the least distorting way. And I want to argue that a progressive consumption tax system can achieve those kinds of goals. I should emphasize, none of what I'm going to talk about is particularly original to me. And that's a very important thing to say. There's a whole legacy of public finance economists stretching over the last 30, 35 years who have made arguments similar to the arguments that I have made and I'm going to make. So it's far from proposing a revolution from the perspective of economic theory. I want to suggest that it makes sense to use economic theory as much as possible in designing our tax system. Our current tax system, as everybody knows, is a hodgepodge. Part of the reason why it's a hodgepodge is because we ask the tax system to do a whole bunch of different things. So one of the important features of the tax system, I've sort of put these in terms of figures that are relatively big relative to others. One of the important features of our current tax system, which makes it not a consumption-based tax system or even an income-based tax system, is that employers who provide health insurance for their employees can deduct those health insurance payments when it comes to paying their taxes. On the other side, households that receive people who work at these companies, like the University of Minnesota, who receive those services, their in-kind services, are not taxed on that income. So if we've got a secretary in the economics department who if you looked at the fraction of his or her compensation that comes from health insurance that the university pays for it, in many cases that amounts to well over 40% of his or her overall compensation. That's untaxed, which is fine, but the terrible thing about this for somebody who likes progressive tax systems is that somebody like me, who makes several times what our secretaries do, for good or for ill, basically for ill, but we don't want to complain about that. Somebody like me gets an effective tax break that's worth 4 times what the effective tax break is to her. So it's a bizarre, very regressive kind of system. It also has, in my judgment, a huge negative effect, which is that it then makes it cheaper for us to get our compensation in the form of health insurance rather than in the form of direct compensation, and thereby tends to drive up demand for health care and tends to drive up healthcare costs, thereby making health insurance unaffordable for poor people. So it's about the worst kind of exemption that you can imagine. There are a bunch of other exemptions. We have 2 children, but in spite of that, this idea of giving people a break for having children is something I had never understood it. Home mortgage interest is deductible, but the true tax break is a failure to tax imputed consumption from housing. Charitable deductions are also substantial. There are good reasons for all of these kinds of things, but these are examples of the sense in which the tax system differs from a progressive consumption tax system. So just to be concrete, all right, here's what a progressive consumption tax system would look like. I think it's relatively easy to do, and I should again emphasize a whole bunch of people. I've copied a bunch of this stuff from some of the work that Seidman has done, Lauren Seidman. Good stuff. So think about households. And this is meant to illustrate the sense in which the transition to a system like this is not that difficult. We're not talking about inventing a whole new tax system or anything like that. Think about defining income the way you do currently, except you add all the values of employer-provided fringe benefits, and you also add in the services from housing that you get from the house that you happen to live in. So you add all of that. That gives you more comprehensive measure of income. And all we have to do under this system, or a system like this, is to keep track of how much you saved in the course of, say, a year. How would we keep track of how much you saved? Well, think about the current system. It keeps track of what you contribute to 401ks, IRAs, education plans, a whole bunch of those things. Think about aggregating all of those and expanding them further. So think about systems which allow you to deduct whatever you saved, and then whenever you withdrew from those accounts, you paid tax on them. It's not that different from the system we have, but you can make this system very, very progressive. There are issues about transitioning to a system like that, and you can get progressive tax rates. If you set up a system like this, you don't really need to tax businesses, but it may be a good idea to tax business income for administrative ease, in which case, if you did that, what you would want to do is to assign appropriate tax credits. And maybe in the question and answer period, we'll get into more detail, because I want to leave a lot of time for that. So why is this desirable? It's desirable because it eliminates intertemporal distortions about how much you save versus how much you consume. It's not too far a departure from the current system, so it doesn't require you to speculate about a system very different from the one we have. It allows for desired levels of progressivity, and also, importantly, if properly set up in terms of the transition phase, you don't end up giving a huge windfall gain to holders of old capital. That's one reason why it's desirable. There's a second reason why thinking about these principles, I think, is also desirable, because it helps you evaluate various kinds of tax proposals and ask whether it moves you closer to this kind of system of progressive consumption tax or moves you further away. So I'll give you one illustration of a relatively recent tax change, which was to allow taxes on dividends and capital gains to be taxed at a lower rate. Superficial analyses of those kinds of systems say, aha, that reduces taxes on capital income. Actually, that's not true. If you lived in an economy, as we do, where the vast bulk of financing for investments is done by cash generated by firms rather than cash generated from externally, then a tax on dividends really looks a lot like a tax on consumption. Reducing a tax on dividends looks like you're reducing a tax on consumption. Presumably, you're raising some other tax now or in the future, possibly a distorting tax. So that's a sense in which that kind of tax proposal, I think, upon closer examination, turns out perhaps not to be quite as desirable. Finally, let me close with, if so many economists think this is a good idea, why is tax reform so difficult? And the simple answer to that is people like to say, oh, special interest this, special interest that. Every one of us is a special interest. The real problem is that we ask the tax system to achieve a whole variety of goals. So we would like to subsidize, say, the education and the healthcare sectors, and so therefore, and perhaps churches also, I'm not sure why, but that's fine. And so we allow charitable deductions to be exempt. All right? Now, is that a sensible social goal or not? It's hard. It's not hard for me to evaluate, but others can make some arguments, not convincing arguments, trust me, for those. So all of these preferences serve some social goal or the other. So the way I think about these kinds of issues is that if we could educate the public at large to see that at the end of the day, all tax systems tax consumption, labor income, and initial capital. And that's all they do. And all tax systems should be thought of in terms of their translation into how they distort decisions on how much to work and how much to save. If we think about things that way, then eventually we're apt to arrive at greater consensus on the kinds of tax systems we ought to have. Thank you.
This one, right? This moves. Hello, everybody. I want to first thank Laura Cullen McKee Markitis for the introduction. She didn't mention she's one of my former star students at the University of Michigan, not at the University of Minnesota. It's always great to be back. I was here as an assistant professor during a golden era of the University of Minnesota Economics Department. I don't want to say the golden era because the department continues to be terrific. I was here during a golden era when Heller-Hurwicz was here, Walter Heller, Ed Prescott, Neil Wallace, Tom Sargent, Chris Sims, Ed Foster, Ann Krieger, John Chipman, Roger Feldman, and in the chair's office, Jim Simler and Ed Cohen and Wendy Williamson on the staff. And my wife and I loved it here. The department was about the friendliest department one can imagine. But more important for an assistant professor beginning his career, it was the most intellectually serious place one could imagine. Economics was not a game at the University of Minnesota. It was serious business. And so it's always great to be back. It's great to see some of my former colleagues. And plus, two of my former undergraduate students are here and two of my former graduate students. Well, Chari talked about, I thought it was going to be, I was going to talk about theory, and he was going to talk about theory, and I would talk about future prospects, but then he pulled a fast one on me by making a concrete tax reform proposal. I didn't say practical, I said concrete. We'll come back to that. So what are the current tax policy questions that we face now? I think there are three. One is how to collect a given amount of revenue. This is the classic tax reform question. You have to raise a given amount of revenue. How should you do it? Should you use a consumption tax, as we've heard proposed today, or an income tax? How broad a base should you have? How progressive should the tax burden be? That's the classic tax reform question. Now we face not only that, but we face a question not only of how to raise a given amount of revenue, but how much revenue to raise given the huge long-term fiscal imbalance the federal government faces and the fragile recovery we're in now. Why do we have a huge long-term fiscal imbalance? Because the promises we've made to ourselves in terms of entitlement programs, mostly Medicare and Social Security, the dollar cost of those programs greatly outweighs the taxes we have in place now to support these programs. Many, maybe almost all people who have thought about this think that sooner rather than later, we need a combination of tax increases and cutbacks in the generosity of these expenditure programs. People disagree about what that combination should be. The President's Commission on Tax Reform suggested it should be a 70% reduction in entitlement programs and 30% tax increases. I heard the other day Kevin Hassett, one of Governor Romney's leading economic advisors, say he thinks it should be and thinks that history has shown that the best combination for long-term growth is 85% cuts in entitlement programs and 15% tax cuts. And the third question is, when should we switch from focusing on the recovery, the fragile recovery, to focusing on the long run? Because if we focus on the long run, we're talking about tax increases and expenditure cuts. Probably not the right thing to do in a fragile recovery. Today I'll focus mostly on the first two questions. Let me talk first about tax reform. The mantra of tax reformers for decades has been to broaden the base, get rid of most exemptions, credits, and the bells and whistles, and use the revenue from doing that to lower the rates of tax that we apply. And indeed, most of the recent base broadening, rate reducing proposals have been part of the comprehensive deficit reduction plans that address the long-term fiscal imbalance. So the President's Fiscal Commission and the other blue ribbon panels of a few years ago all had this characteristic in common. that they would broaden the base, get rid of a lot of exemptions, credits, the preferences that Chari talked about, and also lower tax rates. They all lower headline tax rates. Well, there are two reasons for this. We've talked about one so far, and that is that economic theory supports a broad base with some caveats I'll get to in a minute. But in fact, we don't live in a world where that economists rule, and so we have to look in the face the political reality that tax proposals that lower tax rates provide political cover to politicians, especially to Republican politicians who, if they were ever to be convinced to support a program that raised revenue, they could at least say and emphasize that tax rates came down. This idea of a base broadening, rate lowering tax reform apparently was a conversation between several senators in Washington thinking about the future. Until recently, Senator Schumer of New York State said, given our long-term revenue needs, he didn't understand why we needed to lower rates at all. We should broaden the base and use all of the revenue to deal with the long-term fiscal situation. And those of you, I guess more in the front of the room, who are a bit older, will remember that this was the theme of the last major reform of the U.S. income tax system in 1986. The tax reform of 1986 did exactly this. It broadened the base and lowered the rates that were applied to the tax base, and came about through a maybe once-in-a-lifetime coalition between a president who thought that lowering rates was paramount and important for economic growth and was willing to accept base broadening that many Democrats thought was important to reduce tax sheltering and make for a fairer tax system. Now, this slide has been co-opted by Chari, who preceded me. What is the economic argument for a broader base? He said, and I agree, that the basic argument is that a broader base generates less inefficiency, less distortion cost, in his words, per dollar raised. And of course, we want to pluck the goose with the minimal amount of hissing. But I have to say, after reciting the mantra of broaden the base, lower the rate for decades myself, I am now not so sure that this buzzword or buzz term doesn't lead us into some trouble. So what I've written here is that a broader base generates less inefficiency per dollar raised, except when it doesn't. And what I mean is there are lots of broader base taxes which are bad ideas. So let's go over a few of them. I learned a few minutes ago, I think, that Minnesota has not joined the gross receipts tax bandwagon, but several states, including my own state of Michigan, have moved to a tax which is called a gross receipts tax. It's unlike a sales tax, which taxes retail sales at a flat rate. A gross receipts tax taxes all sales of businesses at a flat rate. Not only retail sales, but business-to-business sales. Now, compared to a retail sales tax, this is a broader base. This is also a terrible base. It is broader and worse. I remember the headline in the local newspaper when our former governor proposed this, and the headline was, Governor proposes lower rate tax. Well, of course it's lower rate, because it's got this huge broader base. It doesn't make it better. It's all economists, or maybe almost all economists, agree that this is more distortionary. If you don't see the logic, imagine this broaden the base, lower the rate proposal. Instead of taxable income being the base, it's going to be taxable income times 10. That would, of course, allow us to lower all income tax rates by 90%. But it wouldn't be a less distortionary tax system. In this case, it would be pretty much the same. In the case of a gross receipts tax, it would be worse. The R&D credit is something that narrows the base, but most economists think is a good idea because basic research and development has positive externalities. It helps people other than the company doing the research. They don't take it into account and therefore not as much as is socially optimal is done. Many economists think there is a good argument for keeping charitable deductions. Many economists think that we should subsidize all goods with positive externalities and tax those goods that have negative externalities, such as pollution. All these things move us from a uniform base and have good justification. Double taxation of corporate income broadens the base in a sense. I mean, after all, corporate income is already taxed for the most part at the corporate level, and therefore taxing dividends and capital gains on corporate stock, again, broadens the base, but does so in a way that discriminates against income earned by corporations. So it looks like a broader base, but it's actually a worse base. And what I won't say much about the last thing on that second bullet point, because my predecessor discussed this. Maybe even taxation of capital income, taxing to any degree interest, dividends, and capital gains, certainly broadens the base in a simple sense, but might be a worse base. So a better base, not necessarily a broader base, reduces the social cost of raising more taxes. And that's the link between the first question and the second question. The first question being, how do we raise a given amount of revenue? And how much more revenue, in particular, do we need to raise? Because a better base reduces the social cost of raising more taxes. If and when we as a country decide to address the long-term fiscal imbalance, and if the way we address it includes higher taxes, we would like to raise taxes in a way that hurts the economy as little as possible. And doing so with a better tax base will reduce the social cost. Progressivity, also already touched on. President Obama says he wants to raise income taxes on households making more than $250,000 a year. Governor Romney doesn't. In fact, the latest incarnation of Governor Romney's tax proposal seems to be that he will not lower rates on high-income people unless he cuts back on deductions and credits enough so that no less revenue will be raised from higher income households on average. As has been mentioned already tonight, the right amount of progressivity involves a trade-off between the economic costs of higher marginal tax rates. The only way to have a more progressivity, to redistribute income from higher income people to lower income people, is to, on average, have higher marginal tax rates. That's going to increase disincentives to earn income, and that's how you get less inequality. So optimal progressivity involves a trade-off between the economic costs of getting the progressivity and the social value of achieving less inequality. To answer this, we need economists, because it is our job to measure what the costs of more progressivity are. They'll reduce disincentives to earn income, increase incentives to avoid and evade. What is the economic cost per dollar of increased cost? That depends on how much people and businesses respond to higher taxes, how much people work less, how much they save less, how much businesses will cut back on investment. This is our bread and butter, and I probably don't have to tell this audience we don't all agree, but this is what we are paid to know. But that's not enough. To answer the question of optimal progressivity, we need to understand both the economic costs of more progressivity and the value, the social value of less inequality. And there, economists can't help. So when the Congress convenes hearings about how progressive the tax system should be, the first panel should be economists who will talk about what their research says are the economic costs of higher taxes and what are the economic costs of alternative ways to raise taxes. But then, after that panel is finished, it needs to convene another panel. It never does, and that would be consisting of ethicists and political philosophers and maybe theologians to talk about what the social value of less inequality is. And you have to put those two things together Or we could just have an election. And I think that's probably how we're going to resolve it. And I always think that one reason we economists can't claim to really be a social science yet is that if you look at economists' political affiliations and then look at how costly to the economy they think higher taxes would be, there's a pretty strong correlation. I don't think there's a high correlation among physicists about how they think about the Higgs boson and their political views. The fact that there is a correlation between economists' political views and what they think about the economic costs of higher taxes, or it could be that their research has caused their political affiliation, that economists who think that they're costly become conservative, but I suspect it's more the other way, and that's not good for our claim to be a science. So I've alluded to this long-term fiscal imbalance. Let me talk briefly about the cause, and the first cause is a demographic one. This is something we have seen coming for decades. The demographic changes caused by the baby boom have been known for decades, and I just want to summarize what that implies for the cost of our entitlement programs in this slide. In 1950, 2 decades almost after Social Security began, 2 decades before approximately Medicare began, people over 65 were 8% of the total population in the United States. Now it's about 13%. In 2050, it will be almost 21%. So the ratio of people over 65 to everyone else has gone up about 2/3 and soon will be 2.5 times what it was 60 years ago. Let's translate that to what it means for Social Security and Medicare. These programs are funded by current working people. In 1950, per 100 covered workers in the Social Security system, there were 6 beneficiaries. So each 100 workers were supporting 6. By 2009, it was 27, 4.5 times higher. In 2050, it'll be 45. The promises we, as a society, have made to the senior population will cost 7 to 8 times more per covered worker in 2050 than in 1950. So this is not about making this slide is not about making Social Security and Medicare more generous. Keeping the generosity what it was in 1950 will cost working people almost 8 times more than it did in 1950. So this is why people who make comparisons to the 50s and 60s and 70s and say, oh, why can't we go back to the good old days when taxes were lower, just aren't facing reality, because we can't go back to the good old days if the good old days means the same generosity of these entitlement programs, because it's going to cost, now it costs 4 or 5 times more, and in a few more decades it'll be 7 or 8 times more. That was that's the biggest cause. The second biggest cause, you probably all know that for Medicare, the cost of delivering quality health care has gone up enormously. So for Social Security, it's demographics. For Medicare, it's demographics plus the ballooning cost of health care. So how big is this fiscal imbalance? Some people measure it by something called the fiscal gap, and that is the size needed to stabilize at current levels the debt to GDP ratio if we made an immediate and permanent increase in taxes and or reductions in spending. How big would, if we just now dealt with it and just by increasing taxes and reducing spending and kept to it from now on, how big would those tax increases and spending cuts have to be just to stabilize the debt to GDP ratio? Alan Auerbach and Bill Gale have done the best work on this, and depending on some assumptions, they come up with a fiscal gap between $29 and $66 trillion. Now, economists aren't good at a lot of things. We can't forecast short term very well, But one thing we're pretty good at is that we know the difference between millions and billions and trillions. And this is trillions. The present value of the fiscal gap is between 29 and 66 trillion dollars, which is about between 4 and 9% of GDP. So let's just to give you a sense of exactly what this means, say it's 6% of GDP. GDP is about 15 trillion, so we would have to have a combination of tax increases, spending cuts of $900 billion this year and every year going forward to stabilize the debt to GDP ratio. Well, if we do nothing, I just wrote ... because there are bad scenarios and there are worse scenarios. If we do nothing or don't do something quickly, what happens is our savings, or a large part of it, goes into buying government debt when it could be going into buying stock and making capital investments. So we wake up 20 years from now and we're not nearly as wealthy as we might have been. That actually is the good scenario. The bad scenario is that someday soon foreign governments and foreign people decide U.S. Treasury bonds are not a good investment because they don't see how they'll be repaid. And then we end up looking like Greece. That's why I wrote ... So let me close, and I'm sure you have lots of interesting questions. Tax policy, as Chari said, serves many masters. We haven't talked about how tax policy in the last few years has been used for short-term stimulus. It should be used to address our fiscal imbalance and get us to fiscal balance soon. It can affect growth. It affects resource allocation. And it certainly can affect inequality or the distribution of income. The problem is, and what makes this hard and interesting at the same time, is that there are often trade-offs among these things. The short-term stimulus makes the fiscal imbalance worse. A more redistributive tax system tends to have more resource allocation and reduce growth. The current debates we're having now about taxes touch on all these aspects, and they're made more vivid by the fact that in a few months we're going to go off a fiscal cliff if nothing is done in Washington, which will add about $500 to $600 billion in tax increases and spending cuts, which, if you're interested in addressing the fiscal imbalance right away, gets us a long way to $900 billion. But if you're worried about the fragile recovery, it goes in the wrong direction. I think the election may resolve how these issues will be handled, but then again, we've had elections before, and it may not. Thank you.
So thank you very much to both of you for your comments. We have time for questions, and we have floating microphones, and so we'll send the microphone your way. And while you're thinking of your question, I'm going to take the moderator's prerogative and ask the first question. And this is a question I thought of for Professor Chari when you were talking about the idea of a personal consumption tax, sort of an unlimited savings account type tax. And I remember when I was at Treasury, the Office of Tax Analysis at Treasury in the 90s, so Nunn and Domenici proposed this kind of thing. And I remember Treasury analyzing the revenue and distributional effects of it. And in order to, you can make a tax like that as to mimic the progressivity of what was the current income tax at that time. And if to do that in a revenue neutral way, though, what I recall is that since you're exempting net capital income, exempting net savings, you end up with, especially when combined with payroll taxes, you end up with a very high tax rate on labor income. And I can't remember what the numbers were, but they were significantly high. And if you add in Joel's what Joel said about that we may not be able to get away with revenue neutral reforms, and we may need to raise revenue. Are you concerned about the degree of burden on labor as a consequence of that kind of reform?
I think so. I think that's a very good question. So there are two issues involved in thinking about this. One issue is what a tax system would look like once you transition to a steady state, and what the system would look like along the transition path. If you set up a system like what I was proposing instantaneously today, then what you would get is a whole bunch of people who have a lot of inherited capital that they presumably saved from, effectively moving it to these kinds of USA-type accounts and thereby reducing their tax liability, even though that's not really consumption.
Right.
And so that's why a system like that, this is one of the things that makes it difficult, has to be a system where the transition has to look partly like an income tax. So the system I was describing is more like what the system would look like once people have basically used up all the old capital. But along the transition path, you do have to worry about this classification
So
issue.
you would not exempt the return to old capital in transitioning?
Absolutely not. I think that's one of the things I mentioned in my slides, is that everything we know from the work of many economists is that taxation of old capital or existing capital is, in efficiency terms, particularly desirable because it doesn't distort any decisions. So it is very important in designing this kind of a system to make sure that you don't exempt, that you don't provide the same exemptions for people who had invested in the past that you're going to for people who are going to invest prospectively.
So, and if such a system in getting through the political process, they actually did exempt the return to old capital, then you would end up with with a different sort of outcome than what you're proposing.
Not only that, I think we'd end up with a much more inefficient system with much greater deadweight costs, as Joe was suggesting.
Okay.
Okay, Laura, can I take the opportunity to explain my offhand remark that the proposal was concrete but not necessarily practical?
Yep.
This system that was proposed certainly has a lot of economists think it is where we should head. In a way, it's like having an unlimited IRA. So now, old-style IRA, where you make contributions to an account which are tax deductible, but then when you take out the money, it's taxed. But it's not quite that, because now this is unlimited, so all your savings you'd want to go into the account. But anytime you take it out or borrow, that's taxed. So one practical limitation would be to convince Americans that when they take out a $100,000 loan, that becomes taxable income. And when they take anything out of their savings accounts, that becomes taxable income. Now, that's just sort of teaching an old dog new tricks, but I wouldn't underestimate the practical difficulty of explaining that as a candidate, say.
Okay, questions? Go ahead.
Speaking of practical difficulties, I heard your comment that the last two, I believe, tax reform measures had a policy of broadening the base. Actually, there are, it seems to me, particularly with the 86 reform, that as a result there were fewer persons paying income tax because some exemptions and credits were allowed in. Democracy is shared burdens and shared benefits, and since it's possible to develop very sophisticated progressive rates. It would seem that one thing that would bring a larger percentage of the people to the table would be if more people paid income tax, even though at modest rates.
Well, I think you've implicitly brought up the 47% debate. So let me first say you've used the term broaden in a different way than we were talking about it. We were talking about, what is taxable and what isn't. You were talking about another important issue, what fraction of American households are subject to income tax. And there is a number out there I've seen in the news recently that 47% of American households don't owe income tax. Let's first qualify what that means. There's another 20-some% of people who pay low payroll tax, and of the rest, many are retired or of very low income. But nevertheless, the political economy question you raise is definitely worth thinking about. If people think that any increase in spending they will bear none of the burden, I think there's no question that they are more likely to be in favor of it, and maybe aren't thinking about that we should only have expanded government programs that are worth the cost. Of course, on the other hand, that means there's a small group of people for whom the cost is a lot greater than that, what they're going to get from any expanded government spending, so you can imagine they're going to fight like hell. One thing, let me just say that one proposal out there that I think will address this question to deal with the long-term fiscal imbalance is a value-added tax. Value-added tax is used by over 150 countries in the world, by every developed country except the United States. Using the typical base of a European value-added tax, a U.S. value-added tax would raise $50 billion per percentage point. So a 10% VAT raises $500 billion a year and gets us about halfway through the fiscal gap. Most people, I think, would feel that because when they go to the store, depending on the law, they would see that there's a 15% value-added tax. Now, Larry Summers, former Treasury Secretary, former president of Harvard, had the best line about the value-added tax ever. He said, the United States will get a value-added tax once conservatives realize it's regressive and liberals realize it's a money machine.
Questions? I see right in the middle there. Yeah.
I'm curious as to what your feelings are on a flat tax.
Yeah, go ahead. Sorry.
And that fiscal gap of 30 to 60 trillion, and you talked about the health insurance laws, and as you probably know better than I do, they're left over from World War II, where the company can deduct it and the employee doesn't have to pay taxes on it. But generally, what I've read, the Social Security side is solvable by raising the age and indexing benefits to inflation rather than wages, so that you don't get your kids won't get any more adjusted for inflation you would get. But the Medicare, Medicaid is not easily solvable. You either have to solve it, I assume, by a top-down, so call it more of a democratic approach, a socialized medicine kind of approach, or from a bottom-up where people have skin in the game and they're going to try to control their costs, and simple things having percentage co-payments where you pay a percentage of a better, knee replacement rather than a straight flat dollar. But maybe both of you or together, would you favor the big fiscal gap? Most of that 30 to 60 trillion is in Medicare, Medicaid. Would you propose more of the top-down approach to try to control that, which you have models around the world of that, or the bottom-up where the consumer has skin in the game, and some people compare like laser surgery for eyes or cosmetic surgery where costs have gone down? Thank you.
Take it?
Sure. That's opening up a big subject. Let me talk about the tensions involved in this. And economists use two buzzwords to describe these tensions. One is called adverse selection and the other is called moral hazard. And these are all buzzwords, but they speak to the essence of the kinds of issues that you're talking about. Here's one problem. We're going to talk about the moral hazard problem first. Whenever you're insured against any activity, your incentives to be a little bit more careful are reduced quite a bit, right? I have a great story which I can tell some of you later on about the nature of this problem, but we have plenty of evidence that when people are insured with respect to their healthcare expenditures, they and their physicians and others pay somewhat and significantly less attention to cost questions when it comes to deciding what the right kinds of treatment is. And that can lead to inefficient outcomes. That's the so-called moral hazard problem. A second issue is what's called adverse selection, and that arises when you have so I should say that moral hazard-like problems suggest that market-like decentralized solutions are very good at solving these kinds of problems, give power to empower users of healthcare, empower the physicians, and so on. You'll get to good outcomes, and don't provide full insurance. That'll give you good outcomes. If adverse selection is a real problem, that arises when I have a lot more information about my healthcare needs than the insurer does. In that case, you get cream skimming, where only relatively healthy people get insurance and unhealthy people don't. Those are the two key tensions. There's a lot of recent work that a bunch of economists, in particular Amy Finkelstein, who was the latest winner of the John Bates Clark Medal, has done, trying to measure the extent of adverse selection. And other economists have looked at actually measuring the extent of moral hazard. Those findings suggest that adverse selection is a much less severe problem than economists had previously thought. It's not completely absent, but it's a much less severe problem. So based on that recent evidence, my own preference is to proceed cautiously at least, and to proceed with market-based solutions to a much greater extent than we have tried. Right now, for good or for ill, we have a central system. A huge fraction of healthcare expenditures in the United States are effectively covered by the government through either Medicare or Medicaid. So anybody who thinks we have a market-based system for the bulk of our healthcare costs hasn't been looking at the numbers. And quite frankly, that system hasn't worked very well. And so it does need improvements, and my preference is to go more market-based. But others may have different views. It's still an evolving area.
Okay. Sure, go ahead.
Let me stumble around with this question a little bit. Today, what we're talking about here about taxes, it appears to me, that raising taxes is a short-term solution, to all of our problems. Raising taxes is a short-term solution. It's not a long-term solution. As economists, what do you feel is the long-term solution, to the disparity of income in this country, the lack of jobs in this country, the lack of good jobs in this country, even getting stumbled. My son, his father-in-law. My son, his father-in-law. He's a farmer down in northeast Kansas. He's got 1,500 acres, of tillable soil, soybeans and corn. Now this year wasn't good because of the drought, but today he does that all by himself. Come harvest time, he might bring a part-time guy in. I mean, back in the 50s, back in the 60s, because I worked on a farm. That would take care of 3 families. 1,500 acres of tillable soil. So you economists, you're looking at this thing as talking about taxes or raising taxes. Yeah, I think the big question is, what is the long-term solution to this income disparity? And I don't think it is. The solution to income disparity isn't, raising taxes or redistributing the wealth. That isn't it.
Okay.
I'll take that one. Okay. I think increased taxes should be part of the solution to a problem, not all our problems. It should be part of the solution to the problem that we've made these promises to ourselves in our old age that are now, for reasons I mentioned, much more expensive than they used to be. What we have to do as a society is decide to what extent we're going to renege on those promises and to what extent we're going to fund them. Like all government expenditure, we should only raise taxes for the programs if we think they're worth the taxpayers' money. We have to, this is what elections are for, I imagine. Increased taxes are possibly, depending on how we resolve that question, are a solution to a serious economic problem, the long-term fiscal imbalance. Is it a long-term solution to all of our economic problems? Absolutely not. The last big recession happened in the middle or near, one might say, of the globalization of the world economy, where 2 billion relatively low-skilled people got integrated with the developed world. Now, very simple economic theory will say that's going to be bad for Americans who are relatively low-skilled and good for everybody else. It's going to increase inequality. Although it's controversial, many economists think that technological change has also widened the inequality gap. Now, I think taxes can offset those trends a little bit, but I don't think higher taxes are the solutions to either of those very serious long-term problems.
Let me interject with a question of my own for a moment here. So sometimes it looks like we, as economists, have all of the needed prescriptions for tax reform, and that there are just these external obstacles to actually getting it done. And you both mentioned several of those obstacles, educating the populace or the electorate about what the impacts would be of tax reform, the political will. Joel, you talked about ethics and ethicists, and I would add, in terms of the broad-based, low-rate type tax reform, the problem that tax expenditure or spending through the tax system allows legislators to look like they're tax cutters and small government types, when what they're doing is actually expanding government with tax expenditures. But let me ask, so the topic is economic theory and prospects for the future, and we probably have some graduate students here who might be interested to know, do we have all the answers with regard to tax reform, or are there some questions that economic theory and economic analysis still need to answer?
Maybe I'll take a crack at that. Obviously, the answer is that there are plenty of unsolved questions. I think one of the central questions, this is a broader question than just taxation, but taxation is an important part of it, is to what extent do markets and voluntary institutions help protect people against fluctuations in their incomes, in their well-being over the course of their lives, and to what extent do markets do that kind of job badly? It's just broadly under social insurance. If you think about what governments in industrialized economies across the world do now, they're mainly insurance companies. Krugman had the right line about this. We are a little bit of an outlier among industrialized economies. Our government is both an insurance company and has an army, right? The rest of the world they're basically an insurance company. And so the basic question is, how do you provide that insurance efficiently? Where do you fill in missing gaps? And so we've had at least one conference under the auspices of HHEI on that broad topic, and that clearly bears on taxation. So that's one concrete example of something that I think is crucially important, needs more work.
Joel?
Well, the students here will be happy to hear that we haven't got the answers to all the important questions. You got to keep working at it. And I think one of the important questions is the effect of taxes on the incentives to earn income, to get educated, to work harder, to invest. And one reason this is a hard question to answer is that if we use data to study this, at best we can look at effects over 10 or 20 years, but it could be that the effect is generational, that I have the ethic that my parents imbued in me, and but my kids unfortunately don't have that, and maybe in Sweden and other even higher tax countries, over the generations, people will make different choices about how much to work and how much education to get. So that's one tough aspect of that. Let me say one more thing. Another unsolved question is how to reconcile the extraordinary amount of micro-evidence about the effect of taxes on incentives. So how do taxes affect the labor supply? How do they affect the incentive of businesses to invest? The incentive to evade taxes. There's an abundance of micro-evidence about how higher taxes reduce the decrease incentives, and that affects decisions. But at the macro level, if you look at, can we say that countries with higher taxes are less prosperous or have grown at a lower rate? The evidence is just not clear. I want to be precise. It's not, what I'm not saying is that the evidence is clear that tax rates have no effect on economic growth. What I'm saying is the evidence is completely unclear. And so out there in the back, students, if you could reconcile the abundance of pretty clear micro evidence about how taxes affect decisions and the completely unclear macro evidence about the same question, maybe you'd have the 4th Nobel Prize of the economics department at the University of Minnesota, or did I miss one? No, just the economics department. Oh, I saw the pictures out there, that's right. 9th, sorry.
I'm just curious, as far as a flat tax, is that in either of yours thinking as a good thing?
So a flat tax, the way most people describe it, has one very desirable aspect, as does a VAT that Joel was talking about. They're both effectively taxes on consumption. But so that's good, in my judgment. The bad thing about this, the criticism of it, is it doesn't meet necessarily the level of progressivity other people may want. And so that's why I think it's more important to think about proposals like the ones that I laid out and ones that others have talked about, which is, are there ways of getting all the benefits of a flat tax while also achieving greater progressivity than a flat tax would? The issue of whether you like that or not depends on your own political views about how much redistribution is desirable. So all I'm saying is a flat tax may be the right thing if Congress and the public at large desire some level of progressivity. A more progressive tax system may be desirable, maybe even a less progressive tax system than a flat tax. But you can achieve any of those with a tax on consumption.
Politicians every 4 years have been known to support flat taxes, and they tend to mean keep the system about where it is and just have one rate of tax. But to economists, the term usually means something else. It means a tax system that does that and broadens the base in the way I've talked about, and is a tax on consumption rather than income. So there's sort of a miscommunication between the term in political circles and among economists. And I agree, if we're talking about the flat tax that economists think about, I agree with the issues that were just raised.
My question's on the expenditure side, that the big expenditure or unfunded liability that we have on, which is the healthcare cost. We've talked about the increase in healthcare costs that's occurred due to technology and many other things, but no one has talked about the number of years of post-retirement living we continue to fund and how we increase that. Has anyone ever made calculations based on, if we talked about the number of years from plan, or in which you're allowed to begin to draw benefits on Medicare, or the year in which you're allowed to draw benefits versus the average life expectancy. Now, we talk about raising the retirement age to a year or 2 or 3, rather than tying it. I'm wondering though if we could phrase that or rephrase that in terms of the number of years of retirement living, because of course both of these programs were started when the retirement age was not much lower than the actual expected life expectancy. So in fact, Social Security, I think, was free in terms of present value at the time it was passed. Has anyone made those, any tax economists made those calculations and sort of put a table up and what we're doing in terms of funding post-retirement?
You're certainly right that the demographic bottom line that I talked about, where in 1950 there were 6 beneficiaries per 100 covered workers, and now it's more like 27. That's the product of 2 factors. More people are living to 65 than used to, and then of the people that get to 65, the average lifespan is much higher than it used to be. And back in the 30s, I think people didn't contemplate this. And it's a great question because there seems to be a disconnect between the debate about Social Security and Medicare. And Social Security, back the last time we had a reform in the Greenspan Commission, the retirement age was gradually increased. And now again, the blue ribbon panels that have reported in the last few years talk about increasing the Social Security retirement age to 69 by 2075. But yet, and when we talk about Medicare, that almost never comes up. I mean, I understand why, if you were going to make a change in the year at, the age at which you were going to be eligible for Medicare, you wouldn't want to do it all at once because people are planning on it. I understand that. But for some reason, that just doesn't enter the debate, and I really don't know why.
Let's see.
Changing the subject back again to VAT. As you say, many countries except the United States use a VAT tax, and it might have some advantages. However, the income tax has one attribute, that it should be relatively easy to make a progressive formula. Whereas on VAT, I don't know that any nation has ever tried to deal with progressivity because I don't know how in the world you'd do it. Any ideas?
I think that
Sure.
goes back to what I was suggesting. A VAT is desirable, a VAT is desirable because it's a tax on consumption, but it is essentially impossible to make it progressive. But there are a variety of other proposals which effectively do the same thing. And so I'm puzzled why there is support for that, and there seems to be less support for changing the tax system in the directions that I thought make more sense. Put very bluntly, I understand why Republicans oppose the VAT, because they look at it as a money machine. Why would Democrats not be more supportive of progressive consumption tax-like schemes? That's something which I don't fully understand.
Let me try two schemes that are out there, see if you like them. So the first has been proposed by Michael Gratz. He's a law professor at Columbia University. So his plan is to increase the exemption level on the income tax to $100,000, thus taking about 85% of people off the income tax rolls and instituting a 15% value-added tax. So between the two, the progressivity of the current tax system is approximately maintained, but the tax system moves much more toward a consumption base than an income base. So the income tax is just for getting that progressivity for the top 15% of income earners. A second idea is called the X tax. This is the idea of a brilliant professor who passed away, sadly, a few years ago, David Bradford, whose idea was to start with a flat tax. Now this is the consumption tax version of the flat tax, but instead of having it be a single rate, to have graduated rates. And again, you can approximately replicate the progressivity of the current tax system. He called it the X tax because he wanted to avoid the question of whether it was really an income tax or a consumption tax, and the name stuck. I feel like I've resisted till now, but I can't help but plug a book of mine that's coming out any day, which is called Taxes in America, Everything You Need to Know. And so the whole book is in question and answer format. So there's what is the X tax? And there's the answer. Can a consumption tax be progressive? Answer. Even the forward is in a question and answer.
So, Charlie, I want to throw this back to you, the idea of other types of consumption taxes, but in particular the value-added tax. So I understand your proposal for a personal consumption tax. Let's just say hypothetically that's off the table for political reasons or so. Would you endorse, or would you think it would be improvement to have an income tax maybe improved upon what we have now, because there's certainly room for improvement, and a value-added tax, and impose the value-added tax and use some of that revenue to reduce the rates on the income tax and/or the corporate income tax. So I understand that you like the idea of a progressive consumption tax, but would you also like the idea of combining a VAT with an income tax in order to achieve progressivity?
No, I think it'd be a mistake to go in that direction. I think because I think it makes more sense to push gradually for proposals that make more sense from an economic standpoint, rather than systems which have difficulty adjusting the level of progressivity to changing political circumstances. That's my main discomfort with with these kinds of systems, that I'm concerned that you're going to lock in some trade-offs with respect to progressivity already in the system.
Okay. All right. Where do we have some questions? Good.
I was trying to figure out how much the economy had to grow if the Romney tax plan would actually work. And what I did figure out was that it had to grow a lot faster than it is today. Now we have a PKUN growth rate, mainly because of very poor productivity compared to other countries. So if we have a productivity improvement from 2% to 4%, we will flood the economy. And there wouldn't be any real problems having people discuss tax cuts. It still is only 1/3 of China's growth rate, or Singapore's growth rate, or many of the countries around the world that are sort of comparable in terms of development. And I'm thinking, isn't it interesting that we have spent so little time in this country how to affect the value-added part of the economy, how to understand productivity and actually make use of it, the way Singapore, who just passed Minnesota in per capita income, same size, and 30 years ago they were a swamp.
If I could figure out how to increase the U.S. growth rate by 2 percentage points over the next 50 years, I would tell you all. I mean, we economists spend our careers trying to think of ways to improve the allocation of resources to increase GDP by 0.1% 1 year. And if we can figure it out, we're happy. But I just don't think we have the secret. You're right, absolutely right, that if we could go to 4% growth for the next 30 years, in 30 years we wouldn't be worrying about a lot of these problems.
Shari, do you have the secret?
No, I obviously not. I'd be out there making a ton of money. I must say one thing about, I've said this before, economists' ability to affect aggregate GDP is very small. But remember that the number of economists and the wage rates that they make aren't that high. So I figure our benefit cost ratio is like 200. But that's a separate discussion. Now, I just wanted to say one thing. You have to remember one thing. It's a lot easier for a China or an India or a South Africa to grow relatively fast. The reason is that what you're doing is you're moving to the world technology frontier. Problem with being a large industrial economy is, guess what? You are the technological frontier. And so the dynamics that affect growth when you are already among the richest countries in the world is very different from the kinds of policies and institutions that you can adopt if you are an underdeveloped country. So that's very important thing to keep in mind. Yes, it's true China has been growing very rapidly, but don't forget, the average Chinese is still adjusting for purchasing power. Purchasing power is approximately 1/5 as well off as the average American, right? So it is a very poor country still. It's growing very rapidly, but it's easier for a very poor country to grow rapidly. Part of what makes it difficult is there was a reason why they're poor. They have institutions that are in serious need of being remedied. But once they do that, it's relatively easier for them to move up the frontier than it is for us to move the frontier forward.
I think we have time for one more question. There you go.
I think we've all grown up in an environment where we all believed that the next generation of Americans are always going to be better off than we are today. And yet we're living in an environment that we've discussed of globalization, and we're currently in a very low growth economy. Can you comment on what our expectations should be going forward?
You're the futurist among us.
Joel says I'm the futurist. I don't know. I mean, I guess we'll end with a futuristic kind of comment. We have lots of problems, untold many problems. But guess what? If you are a young person in Bangalore, it still is the case that where you want to be is in San Jose, California. If you are an investor in Dubai asking, should I put my money in Russia or China or Brazil, guess what? He ends up putting his money in the United States still. So rather than talk about me as a futurist, let me just say that the rest of the world, as far as I can tell, seems to be betting on America. Why should I believe in markets. Why should I say the markets have got it completely wrong? So I think the rest of the world is betting here, and so that's the kind of thing that makes me optimistic, because the market is, in general, right.
All right. Thank you very much. Let's thank our speakers. Okay.
Thank you all. Thank you, Joel. Thank you, Chari. Thank you, Laura. This is a great program, and a special welcome back to the University of Minnesota for you. And special thank you to Ascent, U.S. Bank's Private Capital Management, for their corporate sponsorship. We don't have a date pinned down yet, but sometime January, early February, we'll feature 2011 Economics Nobel Laureate Tom Sargent. Please check our website, hhei.umn.edu, for further details. Thank you all for coming.